Dear investors, my name is Joshua Tan and I'm the strategist at Phillip Securities Research. In our last video on the 19th of September, we continued a cautious outlook for stocks as the Eurozone situation was deteriorating. Indeed, we then had a 232-point sell-off, but since then we have had a 362-point rally on anticipation that European leaders would indeed come up with something substantial to contain the debt crisis. We wrote in our last strategy report, 28th of September, that the market is looking for two things: a plan to ring-fence Italy and Spain from contagion, and a plan to recapitalize European banks in the event of Greek debt relief. On ring-fencing Italy and Spain, the EFSF bailout fund, announced to be levered to 1 trillion euros, is still a number that underwhelms by about 600 billion euros. The EFSF still has a 250 billion unissued capacity, but how this will be levered 4 times is an unknown. Lastly, the fact that the ECB will not put its balance sheet behind the EFSF will mean that Eurozone countries will remain guarantors of EFSF bonds. Hence, this will put potential debt liability onto France, so we wish to note that a potential downgrade of France looms as macro risk, as its debt and fiscal positions are weak. On recapitalizing European banks, such entities have agreed on voluntarily writing down Greek debt to 50% of face value in exchange for new Greek debt with collateral. What this collateral will be is unknown. Furthermore, the debt relief only promises to bring Greece's gross debt to GDP ratio down to 120% by 2020 from its projection of 162% this year. This debt relief is too small in our opinion and is fraught with difficulties to achieve, as the context is negative GDP growth for Greece this year and next, and the inability to generate a positive fiscal surplus this year and next. In light of these, we believe that this issue is not over yet, and that markets may worry again once the euphoria is over. We also have high recession risk in Europe, as PMI numbers show that downside momentum to the Eurozone economy is gaining. In the US, third quarter GDP numbers were higher than expected as consumption strengthened, but we do note that the savings rate plunged by 20% quarter on quarter, indicating that this consumption strengthening may peter out in this quarter. Although manufacturing export is a bright spot for the US economy, we increasingly believe that it will not be able to offset stagnating incomes, a weak job market, and unwinding fiscal supports. In this context, our outlook for the STI remains cautious bearish. Thank you for watching, and tune in next week to PhillipCapital's Market Watch.